Start recording. Hi, good morning. Today we're going to see income tax as per IND AS 12. Hmm, What is this? I'll keep my mic somewhat near. Good enough, clear. Good body. IND AS 12 prescribed by the accounting treatment of income tax. Yeah, we want to account income tax now. So how we do income tax accounting? What income tax is what? It's a expense. Yeah, it's a expense for the books of account. What kind of expense? Eligible expense. It is eligible expense. So how the income tax will be computed, sir? Advance tax we will pay. Okay. And TDS we will collect. For us, someone will collect TDS. So that is in our ledger. That is as asset. Advance tax we pay, that is asset. So advance tax computed, not paid, that is liability. In balance sheet, assets and liability. When we pay income tax, that is expenses. What kind of expenses? Operating expenses. Okay. Anything more? Sir, we have penalty. Yeah, we have penalty. How you consider penalty, sir? Penalty is also expense. So we pay tax as per 234 A, B, C. That is eligible expense or eligible expenses. So we will see how we account as per IND AS. Why IND AS? The international standard. Okay. For the purpose of this standard, income taxes include all domestic and foreign taxes. As a India is now. So it's international standard now. Not only Indian taxes, foreign tax also we need to account. Oh, based on the taxable profit. What is the we will taxable income we will compute. Then after for the taxable income, taxable profit will be computed. Very good. Income tax also include taxes such as withholding taxes, which is payable by subsidiary, payable by associate or joint venture on distribution of the reporting entity. What happened? Sir, we two, three companies joined together and we came up with an idea plan. Okay. Through the idea plan, we did some business. Very good. Through that business, we are getting some profit. Okay. On that profit, we are sharing in some ratio. Okay. That ratio, that profit, we need. What we need? That profit, we can eligible for profit. So that profit, we need to pay tax. So the reporting entity need to pay tax. That is the thing. The principal issue is accounting of income taxes. It's how the accounting of the current and future consequences are known. So, what is the current consequences? What is the future consequences? What is the uh, current consequences? What so we need to be advanced tax. What is the future consequences based upon the future taxes we are paying? Computing advanced taxes to clarify that to go as per the books of account, go as per the law. Okay. The future recovery, settlement of carrying amount of asset liability that are recognized in the entity's balance sheet. Yeah, what is the future recovery? Asset I going the tax I going to pay, or a settlement I going to go on. Mm. Or example, I going to incur some expenses. Then is taxable expenses. Liability I going to we can go in some different concept as per the income tax. So income tax transfer pricing, one provision is that what is a transfer pricing? Profit from India is moved to other country. Singapore example. If the same goods is being transferred to Singapore by other person, this is the amount. And if I sell the same goods, this is the amount, which is somewhat higher. So both the Singapore company and Indian companies are associate company. They hold substantial interest in this company. Right now, it's profit shifting now. Yeah. Of exporting some goods in higher cost, what I am incurring, I am getting more profit. Then no problem. Government say Singapore government may not agree about it. At the same time, I am giving the same goods in lesser cost. How? So I purchase for 100 rupees, but I'm selling for 95 rupees. ₹5 only, sir. But the unit is 1 lakh units. Oh my God. I incurring mandatory loss of 5 lakhs. For what? Purchasing and selling to company. Since this is what indirectly by doing some activity, I'm incurring loss on it. Transfer pricing provision won't allow it. Income tax provision won't allow it. So based on this, a liability has been. They will say, so I'm reducing up taxes such a way you can't tax me. They may say, but fortunately, when you see in a different angle, it is their profit which has been eroded in a way of transferring the goods. So transferring something to another price. So by the way, they are getting incurring some losses, which is manipulating the books of accounts indirectly. So such a loss has not been considered. So on that 5 lakhs, you say it is a loss, it won't be considered as loss. It will be taxed. It will be taxed. That's what. The transaction. Okay. The transaction other events of the current period that is recognized in the entity's financial statement. So what are the transactions that going to be happen? The event that lead to transaction, the transaction that lead to events. So both things to be taxed in the entity. Sometimes be taxed, sometimes should be recognized in the books of account. That may be futurely taxed. Okay. In the 12 also deal with the recognition of deferred tax asset arising from unused tax losses, unused tax credit. AMT. Yeah. We will pay, we will MAT provision or AMT provision you put na. Yes. AMT for individual, MAT for companies. So when you put MAT, alternative tax, minimum alternative tax, if you go for it, that will create an tax provision. Yes. That tax provision based upon the differences between the depreciation or the expenses, you need to pay some taxes. Yeah, I need to pay some taxes. Now the tax I will pay will be in my tax credit. A tax credit can be either asset or liability. That is also be recognized. That has been said in this NDAs. The presentation of income tax in the financial statement and disclosure of information relating to income taxes. NDAs 12 based on the balance sheet approach. Always it is based on the balance sheet approach. It requires recognition of tax consequences of difference between the carrying amount of asset and the liability carrying amount of liability and the carrying amount of the tax base. Oh, carrying amount of asset to liability, I can understand, sir. But what is on the tax base? In which country you are? You have been consolidated financial statement. That is 10 countries you have holdings. All things combine, you bringing consolidated balance sheet. So when you compute the income tax, it's not based on the one country, it's based on all the 10 countries combined. 10 country specific taxes to be computed or proportionally taken to arrive at this balance. Okay. Tax base of an asset, tax base on liability. You will see tax base of asset means amount that will be deductible as tax purpose, will be deductible as tax purpose against any taxable economic benefit that will flow to an entity, that will flow to an entity. உள்ள வருது. They'll coming inside. When it recovers that carrying amount of asset. Okay. And if those economic benefit will not be taxable, not taxable now, the tax base of asset is equal to carrying amount. Sir, asset, sir, taxable value, sir. On the taxable value, tax to be computed, sir. Then after get the profit after tax, sir. Here, asset after tax, sir. So even though there is asset, that asset is a future or present obligation of not present obligation, present opportunity or future opportunity of coming flowing in of income. That income is subject to tax. Liability, the carrying amount less any amount, carrying amount less any amount will be deductible from for tax purpose. Will be deductible on TDS I pay. It is deducted, sir. For an professional, I'm doing some professional activity. Oh, I have received some professional activity. For the professional activity of 1 lakh, I need to pay 10,000 TDS. Right now, I need to pay 10,000 TDS. Now, what is the thing? How much TDS do we need to pay? Nah, rest need to be paid. in respect of the liability of future product. Because I need to file the forms for 26 Q I need to file. For filing the form, what I need to do? I have to deduct TDS, right? Very good. So when for the 26 TDS, it is filing, but 7th of every month I need to remit the tax, right? Yes. In respect of the liability in the future period, in the case of revenue which is received in the advance, so revenue received in advance, the tax base is carrying amount less an amount of revenue that will not be taxable in future period. So the amount liability na sir, I had to pay the tax right now. After paying the tax, that amount which I got, it's not subject to any tax. That is tax liability. Once it is done, for a tax base is not immediately apparent. I don't know. For them, there with certain limitation expectation, some limited expectation, recognize a deferred tax loss liability, whether recovery of settlement of carrying amount of asset or carrying amount of liability would make a future tax payment is larger or smaller. So, and the carrying amount asset இருக்கலாம், liability ஆக்கலாம். But the future payment can be பிக்காவும் இருக்கலாம், சும்மா சின்னதாவும் இருக்கலாம். That would be if such a recovery or settlement were to have no tax consequences. So whatever that may be, the amount which going to show in your books of account should be what? After recognition, no tax consequences there. So example, I had paid the professional fees of this much. So TDS to be remitted, you should account this. TDS payable should be accounted it. That is the rule. When you pay professional fees, you need to add GST, you need to pay right now. The professional fees is payable, TDS to be deducted and remitted to government. These are mandatory clause. When you account this, all these things to be asset, all this thing to be accounted. When the GST payable is paid and it should be accounted as asset. Okay, there is no difference. You should pay that and you should not show that. No. Everything should be properly accounted. You can't leave something. That is being said all is here. So every point which is recognizing it, I'm not bringing in GST here, but income taxes, whatever to be accounted should be accounted, and there should be no future taxability. When the revenue is recognized, there's no future liability. When a tax base of the carrying amount is given, there should be no taxable thing should be there. So when you account something in the books of account, it should be completed and it should be sealed. Why they are saying so, sir? If you accounted wrongly, what the asset what you are showing, it's not the fair value. Why income tax authority will not accept it, and they will come for recovery of tax. When they want to, they come for recovery of the tax. The asset what you mentioned will be subject to auctioning by the government. When they auction it, it's not your asset actually. It will become asset of the government, and the residual value after auction will be your asset. And that even not your asset. Your asset will completely remove. So to bring in clarification in international standard, this has been what the current tax for current and prior period shall be extended unpaid. She recognizes a liability. Yeah, current tax is liability. I need to be advanced tax liability. If the amount already paid in respect of the current and prior period exceeding the amount due to this period, the excess shall be recognized as that. Sir, advanced tax is 1 lakh, sir. I paid 1.1 lakhs. 10,000 I paid extra. So I will get refund. Right? Then it is asset for me right now. Good. The benefit relating to tax loss that can be carried back to recover current tax of previous period shall be recognized as asset. But benefit relating to tax loss. Sure, I have a loss carrying forward. Okay, that loss carrying forward is being what? Substantiated. What substantiated? As per the income tax provision, anyone can carry forward loss for 8 assessment years. Right? Yes. In this 8 assessment years, what happens? In this 8 assessment year, if you incurred any profit, that carry forward loss can be knock off, knock off. It can be knocked off, or it can be set off. Set off provision is there now. And the set off provision, the loss is asset right now. That has all been said. Temporary difference, a difference. Oh, the as per the income tax, you should account for carry forward loss also. You should think how you account for carry forward loss. Arey Rama, you need to pay tax this much, sir, this year. Okay. How, when, where will this come? What happens is, after this problem will not come here. This problem where will come now? Mm, example, when you put the P&L account, P&L account la last profit before tax, profit after tax, taxes no you post. In this will put zero when you fought carrying forward loss. Yeah, but it is asset na. But this carrying forward loss will not be shown in any books of account. Why? Why it's not shown? Because in the balance sheet, if you see, reserves and surplus will be every time the loss will be carry forward to reserves and surplus, and reserve surplus will decrease. You can see the books of account, but it would never been shown in the books of accounts as asset as carry forward loss. As per the income tax act, it is carry forward loss. So this accounting has bring into opportunity to how to show off carry forward loss. That is a very good thing. Okay, you will see how we can show temporary difference. What is temporary difference? Temporary difference are between carrying amount of asset and carrying amount of liability in the balance sheet and tax base. Always there will be difference. But sir, I said the carrying amount example. Uh, Asset is this much. 1 rupee, 2 rupees difference will come. Because income tax usually computed a rounding off of 10. Yeah, we may be accounted correctly. But sometimes when it round up 1, 2, 3 rupees will be carried for rounded off. The rounding of error usually come. But we can rather convert to expenses or asset. Taxable temporary difference. Temporary difference that will result in taxable amount determinable taxable profit tax loss of future period when the carrying amount of asset or carrying amount liability is recovered or settled. So we would have shown it as asset, or we have shown it as tax loss. But fortunately we have received the amount. What do you say? Sir, we are going for a tribunal case. We have to pay tax as per the income tax of rupees 5 lakhs. It's a liability in the books of account we having. In contingency we should add na because the COVID is in the case. But fortunately, due to our beautiful chartered accountant and lawyer has combined their brains and they waived off this amount. So the contingent liability which is there, it has been closed. So how will you deal it? That's a temporary taxable difference. Then deductible temporary difference. What is deductible temporary difference? The temporary difference that will be result in amount so that deductible in determining taxable profit. But taxable profit, like sir, where how we are speaking about taxes. When you go forward, how tax to computer, sir, sales minus so no, as per the income tax act, something what salary, then what 5 heads of income. Then income from house property, income from business, income from capital gain, income from other sources. This all the head we will add and we will come to arrive into something. Then after we will have chapter 6 is deduction. After deduction we have something. It is known as taxable value. Right? Taxable income. Right? This taxable income as per the Companies Act and income tax may come up with some difference. Yeah, it will come up. Why? As per the Companies Act, some expenses are deductible expenses. As per the income tax, that is disallowed. That is disallowed. So such kind of temporary difference. In India, we know, sir, when you accounting for the all over the world, huh? You have country, you have a companies all over the world. When you're doing consolidated financial statement, you need to think abroad. You should think very broadly. That is a problem here. Okay. Uh, so the profit period, which is carrying amount of asset or carrying amount of liabilities, recovered or settled. This is the thing. Or the temporary difference may be taxable or deductible. Taxable na deferred tax liability will show. And the deductible na deferred tax asset will show. Why, sir? When deducted, it is became asset to me. I can clarify in future. When it is untaxable, that become liable to me. I have paid. The liability can be done. The deferred tax liability. Deferred tax liability. The amount of income tax payable in future period in respect of taxable temporary difference. I need to pay it. Deferred tax asset. The amount of income tax recoverable in future period. Sir, when I pay income tax, I should reduce it from income tax. But tax deductible liability, na, sir, when I pay income tax, it's a liability for me to pay along with it. As per my income tax, the income tax is 1 lakh. But due to my deferred tax liability, I need to pay 1.2 lakhs. Mhm. But at asset, na, so I want to pay 1 lakh. But fortunately, as an asset in my books, I don't need to pay 1 lakh. I can pay only 90,000. Actually. The deductible temporary difference, carry forward unused tax losses, carry forward unused taxes. These assets can be difference and assets and losses. Deferred tax liability should be recognized in all taxable temporary difference, except to the extent to the deferred tax liability arises from the initial recognition of goodwill or initial recognition of asset or initial recognition of liability. The transaction which is not a business combination at the time of transaction. So it business combination, it may be transaction, it may not be transaction. Affects neither accounting profit or taxable profit. It inherits the recognition of asset or inherits the recognition of liability that the reporting entity expect to recover, reporting entity expect to settle the carrying amount of the asset, the carrying amount of the liability. What? Tax to be paid, yeah. Or tax to be recovered, yeah. Right. The business combination, maybe a single company or business amalgamation or even consolidated financial statement that may affect different example. I having company consolidation is mostly based on companies only. Okay, but if there is an specific interest you have, but as per IFRS provision, that is also to be considered. Then what you will do? So then there is clash in between taxation base, that is different country, different tax bases. These all to be considered. That is being said here. The probability the recover or the probability of settlement of the carrying amount will make the future tax payment larger or smaller. That would be if the recovery or settlement would have no tax consequences. But the probability should be there. Sir, either I need to carry forward it or settle it. What? Sir, I should recover the tax. Government will pay. I'm sure it will pay. Oh, then good. Settle it. Sir, I need to pay. I don't have money right now, but I will pay it. Some kind of settlement will come out. You can't say income tax payable this year. I will carry forward it. You can't say that. You need to pay. Or you could come with a penalty. 18% interest rate they will post on. Oh, this is the thing. The standard requires then entity to recognize a deferred tax liability or deferred tax asset with certain limited expectation. Okay. The deferred tax asset should be recognized in all deductible temporary differences, and to the extent it is probable that taxable profit will be available against a deductible temporary difference can be utilized. Yeah. The temporary difference, what is there to be utilized now? We have a deferred tax asset. That asset is of paying something, you having it as asset. When the opportunity rises, you should clarify. You can clarify it. What you can reduce the tax payment on the future period. Same time, if there is a temporary difference comes upon this, I don't know, you can directly book it in P&L account. No issue. Unless a deferred tax asset arising from initial recognition of asset or initial recognition of liability in the transaction that would not be a business combination at the time of transaction and affect neither accounting profit or non-taxable profit. So if it has not been a business combination, if it doesn't affect any assets and liability, then the initial, it's not even asset or liability. Okay. Then unused tax losses and tax credit. What? Sir, I am carrying forwarding for 8 layers, sir. It's not been used. Carry forward. Deferred tax, deferred tax asset should be recognized for carry forward of unused tax losses, unused tax credit to the extent that is probable that a future taxable profit will be available against which unused tax losses and unused tax credit can be utilized. The deferred tax asset in normal accounting statement we have used in different format, but in the NDAs it be used for what carrying forward of unused tax losses and unused tax credit. Okay, it is inherent to recognition of liability that the carrying amount will be settled in future period through outflow of the entity of resources embodying economic benefit. When you consider as a tax asset, it can be used anytime to reduce the outflow of economic resources. Hey, I need to pay tax, da. For reducing the paying tax, I need to pay money, da. That is outflow of resources, da. That can be what? That can be knock off. No issue. I don't need to pay. When the resources flow from the entity, the part of all the amount may be deductible in the determining taxable profit a period later than the period in which liability is recognized. So, but income tax payable, that payable be if I have a balance, sufficient balance with the carry forward, deferred tax asset, carry forward losses, or deferred credits that can be utilized fully or partially. Fully, if there is no completely, you can do it, no issue. In this case, there a temporary difference exists between the carrying amount of liability and its taxable basis. Sometimes there is a temporary difference. Now you can use it, not an issue. Temporary difference either can be paid through this default asset or book it in P&L account, no issue. The entity recognizes default assets only when it is probable the taxable profit will be available against a deductible temporary difference can be utilized. Sir, our temporary difference arises, sir. Okay, what you can do? Book it in the carry forward default asset. So when I can do it, I'm assured there will be profit in future. Okay, that profit can be adjusted with this profit. That profit can be adjusted with this deferred tax asset. Okay, if you profit will come now. Okay, profit no come now. Don't book it. Book in P&L account. When the entity assesses whether the taxable profit will be available against which can be utilized in deductible temporary difference, it considers whether the tax laws restrict the source of taxable profit against when it comes against deduction on a reversal of the deductible temporary difference. Asset is there, taxable profit will be there for what? To knocking off this temporary difference. So you can book now, okay, but whether the law restrict, the law say you can't, any difference is there, the difference is not to be added to this taxable difference. What law, sir? India, no problem, sir. When you go to other country income tax, if they doesn't approve in the business, you be consolidated financial statement. When that country is the temporary difference, if doesn't allow that, you should not do it. That was been said. The tax laws imposes no restriction. ஓ ஒண்ணும் பிரச்சனை இல்ல. எதுனாலும் பண்ணிக்கோங்க அப்படின்ட்டாங்கன்னா, the entity assesses the deductible temporary differences. The difference in combination of all of the deductible temporary differences. And the combination when you brought it, everything will be got na. That's what it said. However, if the tax restrict the utilization of losses to deduction against income of specific type, the deductible temporary differences assessed in combination only with the deductible temporary differences of appropriate type. So that government say, sir, if you have temporary difference here, one temporary difference can only be utilized deductible with the other temporary difference. This kind of specific only you can do, or else you can't do in the business combination. If the law restricts you to utilizing of such kind of losses, then you should follow that. Okay. What? Measurement, what is measurement? Current tax liability or current tax asset. For the current and prior period shall be measured the amount expected to be paid or recovered from taxation authorities. Okay, how many pages is there? Offsetting, disclosure. Two pages are complete. Okay. Sherman, current tax liability or tax asset of the current and prior period shall be measured at the amount expected to be paid or amount expected to recover from the taxation authority using the taxation rate and taxation law that has been enacted, substantially enacted by the end of the reporting period. What is it? Sir, I want to pay tax. I need to compute tax. How you compute tax? As per the tax rates or as per the current tax laws. As per that country you should do. Okay. And if I going to recover tax, okay. So I know that I won't recover this much. If you are assured that you don't recognize that, no issue. So whatever you recognizing, it should be recoverable. Or sir, if I'm said that I need to pay this much amount, but the department is worst, sir. They will charge some interest unnecessarily. Even though you gave as per the tax rates, there is in future obligation on paying tax, and it also no issue. No issue. As per that country's laws. The deferred tax asset and deferred tax liability shall be measured at the tax rate that is expected to apply to the period when the asset is realized and the liability is settled based on the tax rates or tax laws that would be enacted or substantially enacted by the end of reporting period. So from this, what we get tax asset and tax liability will get. How it is come based upon the measurement. How we measured it based on the tax rates and tax laws. And for what? For that specific period you did it. Okay. So upon that, what we got? We have got either asset or liability. What is asset? That can be recovered. What is a liability? That need to be paid. And these all based on what? Tax rates and tax laws. On what? On that country. Okay. Which is being enacted. Enacted na that government, that country, that policy of that constitutions we need to follow. For what? To that ending period. What ending period? As per that country ending period. Okay. This all to be considered. If current tax and deferred tax, that's the difference. Relating to transaction recognized and current tax and deferred tax are recognized. What? Uh, Transaction recognized the other comprehensive income. Current and deferred tax are other comprehensive income. Super. Relating to equity, in equity only. And other as income or as expense in profit and loss account. So transaction is other comprehensive income no transaction na. Other comprehensive income you can show, no problem. Equity you want to have some ready transaction, equity you can do. In the current tax and deferred tax recognition. In other current and deferred tax comes na, it should be considered to income and expense of profit and loss account. You should not go to comprehensive income. Okay. Said na previously. What I said, sir, there is a temporary difference. As per the act, you can recognize, you can recognize. If it has not been appreciated in the act, now what you can do? So directly go and push it into P&L account. And offsetting, carry forward offsetting. The entity shall offset current tax asset and current tax liability if and only if the entity has a legal enforceable right to set off the recognized amount. Amount is there. You need to set off. When you can set off, that should be legal enforceable right. What? Legal enforceable right now what? Government said that you can do it, sir. I don't care. If they gave in the provision, now you can do. You can't think so. Government has said no, you should not do. Okay. Super. Intent either to settle on net basis or to realize the asset or settle the liability simultaneously. What is your intent? Sir, my intent to settle the liability or realize the asset. What? And I will pay the taxes or I will recover the taxes. That is my intent. Or else, or to, sir, I need to pay some taxes. You just subtract it from the my payable. You give the amount. It's a given what? It is offsetting. But this should be enforceable by the government. Entity shall offset deferred tax asset and deferred tax liability if and only entity has a legal enforceable right to set off current tax asset and current tax liability. And GST la input can be strike off with output with some conditions. Likewise, input income tax la TDS collected can be set off against my advance tax. Yeah, I want to pay advance tax. They have collected TDS on my service. So the advance tax, I'm subtracting my TDS. Then after I'm saying that this is my tax amount, I have paid already. You need to pay off. That is setting off. As per the TDS act that is there, that we can follow. A default tax asset and default tax liability related to income taxes lead with the same taxation period or same taxable entity. Yeah. So usually you can put anything